Hi everyone and welcome back to the channel. If you're like most people, you probably think you need a fat stack of cash, thousands and thousands of rands, just to get your foot in the door of the investment world. Well, I'm here today to tell you that's simply not true. What if I told you that you could start building your wealth right here in South Africa with just a single green note? So where do you even begin with such a small amount? The answer is simpler than you think, thanks to platforms designed for everyday South Africans. Let's talk about my personal favorite for getting started, EasyEquities. Now, this isn't a sponsored post. It's just a genuinely fantastic tool for beginners. The biggest barrier for new investors is often the high price of a single share in a big company. Want to own a piece of Naspers or an American giant like Apple? The price for one full share can be intimidating. But here's the magic of EasyEquities. It allows for what's called fractional share investing. This means you don't have to buy a whole share. You can buy a small piece of it. With your R100, you could own a slice of multiple companies. You're not just dreaming about being an investor. You actually become a part owner of these massive corporations. The platform is designed to be incredibly user-friendly. There are no complicated charts or confusing jargon thrown at you from the start. It strips away the complexity and makes your first investment as easy as ordering a pizza online. It's built for South Africans who want to start small and grow steadily, making it the perfect launch pad for our R100 challenge. Now, before you rush off to buy your first fractional share, let's talk about the smartest way to house your new investments. You've probably heard the term TFSA, or tax-free savings account, thrown around. This isn't just another bank account. It's a powerful investment vehicle given to us by the government to encourage saving and investing. Here's the deal. Any growth your investments make inside a TFSA, that's dividends, interest, or capital gains, is completely tax-free, forever. You can contribute up to 36,000 rands per year, but don't let that big number scare you. Let's imagine you put R100 into your TFSA every single month. It might not feel like much initially, but this is where the magic of compounding comes into play. Your money starts earning returns, and then those returns start earning their own returns. Over time, the snowball effect can turn your small, consistent contributions into a significant nest egg. By using a TFSA, you're ensuring that every cent of that growth belongs to you, not the taxman. It's the ultimate cheat code for long-term wealth building in South Africa. Okay, so we've got our platform, EasyEquities, and our secret weapon, the TFSA. Now, what do we actually buy with our R100? It can be tempting to try and pick the next big thing, but that's a risky game. A much smarter strategy, especially when you're starting out, is to focus on diversification. The old saying, "Don't put all your eggs in one basket," is the golden rule of investing. But how do you diversify with just R100? The answer is exchange-traded funds, or ETFs. Think of an ETF as a prepackaged basket of investments. Instead of buying one company, you're buying a tiny piece of many companies all at once. For example, you could buy an ETF that tracks the top 40 biggest companies on the Johannesburg Stock Exchange, JSE. With one click, your R100 is spread across the titans of South African industry. Or you could choose an ETF that tracks the S&P 500, giving you instant exposure to the biggest companies in the US, starting with one or two low-cost. Broad market ETFs is a brilliant way to build a simple, yet powerful portfolio. You get instant diversification, which reduces your risk, and you can do it all for a very low fee. So for your first R100, consider splitting it. Maybe R50 into a local JSE Top 40 ETF and R50 into a global ETF, just like that. You're a diversified global investor. It's that simple. Your investments are bought, and they're sitting nicely in your TFSA. So what now? Do you check your phone every 5 minutes, panicking at every little dip? Absolutely not. The key to successful long-term investing is patience and a hands-off approach. Frantically checking your portfolio will only stress you out and tempt you into making emotional decisions, like selling when the market is down, which is the worst thing you can do. A healthy approach is to check in on your portfolio, maybe once a month. Just see how things are going. A great habit to get into is reinvesting any dividends you receive. Dividends are small cash payments that companies pay out to their shareholders. Platforms like EasyEquities often let you automatically reinvest these, which adds more fuel to your compounding engine. Use the app to track your progress over the long term, not the short term. Remember, investing is a marathon, not a sprint. Your goal isn't to get rich overnight. It's to build sustainable wealth over years. Consistency will always beat speed. Keep adding that R100 whenever you can. Stay patient during the downturns and trust the process. Your future self will thank you for it. So there you have it. You don't need to be wealthy to start investing. If this has been helpful and you want a more detailed, step-by-step guide on building a beginner portfolio from scratch, let me know in the comments below. I read every single one, and if enough of you are interested, I'll make that my next video.